All right, welcome to the Explainer. Today, we're putting on our detective hats and conducting a full-on forensic investigation. We're tackling one of the most persistent and, frankly, most confusing issues in retirement planning: how to correct an excess Roth IRA contribution that you made in a prior year. We're going to get into the weeds here, looking at the specific IRS forms and code sections you absolutely need to know to close this case. So let's get right into it. Everything we're talking about today really boils down to this one number, 6%. And look, this isn't some one-and-done penalty you pay and move on. Oh no. This is a recurring excise tax that hits you year after year after year for as long as that excess contribution is just sitting there. It's a problem that literally compounds if you ignore it. So to get to the bottom of this, we've got a clear game plan. We'll start with the tax itself, then we'll define what an excess contribution even is, talk about the timing of corrections, get into the nitty-gritty of Form 5329, cover the big changes from the Secure 2.0 Act, and finally, lay out the absolute best way to report and fix this mess. All right, Section 1, the persistent tax. First things first, we need to understand the crime scene, right? And to do that, we have to look at the law that defines it. And that's Internal Revenue Code, Section 4973. Okay, this right here is probably the most important distinction we're going to make all day. You see that quote? It is hammering home one simple point. This 6% charge is a tax, not a penalty. And you might be thinking, okay, tax, penalty, so what? Well, it is a huge deal. The tax court made this crystal clear in the landmark Pascal v. Commissioner case. Because it's a tax, it has its own set of rules. It actually requires its own separate tax return. That's Form 5329. And that fact alone completely changes the game for things like the statute of limitations and reporting. This isn't just semantics, it's everything. So moving on to Section 2, we've established it's a tax. But what actually triggers it? What is the contraband here that we're looking for? Well, for that, we have to go straight to the source, to IRC Section 4973F, for the official definition. And here's what the code tells us. An excess contribution isn't just a simple one-time mistake. It's actually a two-part formula. Part 1 is easy. It's the amount you put in this year that was over the limit. But then there's Part 2, any uncorrected excess from the preceding taxable year. And this is where it gets really nasty. The code literally forces you to carry forward your old mistakes. And this is exactly how that snowball gets rolling down the hill. You calculate this year's mistake, right? And then you have to tack on last year's uncorrected mistake on top of it. That means an error you made, say, 3 years ago? Yeah, it's still part of the calculation today. And it's going to keep triggering that 6% tax year after year until you finally step in and resolve it. It does not just go away on its own. On to Section 3, timely versus untimely corrections. So, knowing the problem, how do we stop the bleeding? Well, time is absolutely of the essence here. The code gives you two very distinct windows to fix this, and believe me, they come with very, very different rules and consequences. Now take a look at this, because the really fascinating part is how you handle the earnings on that excess money. If you catch it in time, that's a timely correction under Section 408D4, you have to pull out both the principal and any earnings it generated. We call that the net income attributable, or NIA. But if you miss that deadline, for an untimely correction, you are not required to pull out the earnings. Now think about that for a second. That means those earnings can actually stay in the Roth account, continuing to grow tax-free. It's a really interesting little quirk in the rules. Okay, on to Section 4. Let's talk about our main piece of evidence, our investigator's toolkit, Form 5329. For our purposes, we're zeroing in on Part IV for Roth IRAs. This is the form where you lay out the whole case, the crime and the correction, for the IRS. This form is it. It is the official record. It's where all the math happens. And, failing to file this form is one of the biggest and most critical errors you can make. So let's break down the key lines you'll be using for a prior year correction, because each one has a very specific forensic function. First up, line 18. This is the carryover. Just think of it as the previously on for your tax situation. You literally take the excess amount from last year's form, from line 24, and you plug it in right here. This is the official mechanism that makes the tax cumulative. It's how the IRS keeps the clock running. Now, line 19, this one is a real game changer. This is the absorption. Let's say you have contribution room this year that you aren't going to use. Well, you can use that available space to absorb last year's mistake. You're basically telling the IRS, hey, that excess from last year, I'm going to count it as my contribution for this year. And just like that, you stop the 6% tax going forward, all without having to pull a single dollar out of your account. It's an incredibly powerful strategic tool. And then we've got line 20, the withdrawal. This one's pretty straightforward. This is where you report that you physically took the excess money out of the account. By reporting it here, you directly reduce the amount that's subject to the tax for the current year. You're officially documenting that you have removed the offending funds. All right, Section 5. Now, just when you think you have all the rules figured out, Congress goes and changes the game. And that's exactly what happened with the Secure 2.0 Act of 2022, which fundamentally rewrote the playbook on all of this, especially when it comes to the statute of limitations. And I mean, this was a massive, massive shift. Before Secure 2.0, based on that Pascal ruling, if you never filed your Form 5329, the IRS could theoretically come after you for that 6% tax forever, indefinitely. There was no time limit. Now, thanks to the new Internal Revenue Code Section 6501L4, there's a hard stop, a 6-year statute of limitations, even if you didn't file the form. That clock starts ticking from the due date of the return for the year the mistake was actually made. A huge relief. But, and this is a really, really important but, there's a major exception baked into that new law. It's for something called a bargain sale. This is designed to stop people from, say, shifting an asset into their Roth IRA for way less than it's actually worth. If the IRS asserts that's what you did, guess what? That brand new 6-year statute of limitations, it just disappears. Poof, gone. The risk in that situation becomes permanent. It's a serious trap for the unwary. All right, our last section, Section 6, Reporting and Mitigation Hierarchy. Let's pull all these clues together and build a clear step-by-step action plan for closing the case on an excess contribution, both properly and strategically. So, proper reporting is absolutely key to finishing the job. When you make a correction, your IRA custodian is going to issue a Form 1099-R. You've got to pay very close attention to Box 7. That little code in there is a direct message to the IRS. A code P is for a timely correction of a prior year contribution, which signals that the earnings are taxable in that prior year. A code J, on the other hand, signals an untimely distribution. Getting this code right is absolutely essential. So, when you're faced with this problem, you need to think in terms of a hierarchy. What's your best move? Well, number 1, if you're still within the deadline and you're eligible, recharacterizing to a traditional IRA is always the cleanest best fix. Period. If you can't do that, then a timely return of the excess is your next best bet. Now, what if you just discovered an error from years ago? That's when absorption, using line 19, becomes your superhero. And way, way down at the bottom of the list, your absolute last resort is just doing a simple distribution of the principal. You really want to work your way down this list in order. And that brings us to our final thought. Secure 2.0 gave us this great gift, right? A statute of limitations where there wasn't one before. But it also gave us this bargain sale exception, this hidden trap with no time limit at all. So the question is, was it a fair trade? Did it really help taxpayers more than it hurt? Or did it just create a brand new permanent risk for certain types of transactions? It's something every professional in this field really has to grapple with now.